Hi, my name is Keith Halson. I'd like to welcome each and every one of you to this webinar that I'll be presenting for you today. It's an honor, first of all, just to be able to have each of you as part of my team. And even if you're not, what the greatest honor is that you're part of the great team called Youngevity. Because of the complexity of the tax laws, and guys, you talk about some laws that are indeed complex, and it takes lawyer upon lawyer upon lawyer just to get them all. So we're going to break this down into two different sessions or two different webinars to help you understand exactly what we're doing. In fact, to kind of help you let you know how hard the tax code truly is, many years ago, Albert Einstein said the hardest thing to understand in the entire world is the income tax. Now, if he said that many years ago, I think if he were alive today and looking and seeing all the volumes upon volumes upon volumes of code that we have, and that code is added every year, that he would he'd probably wonder if we were sane in and of ourselves. Now, just to let you know that this is not going to be, if you're looking for a very complex or detailed type webinar, this isn't for that. This is to teach you the basics, and with the basics, you'll be able to go out and for, I would dare say, 98 to 99% for all the people that are in my downline, this is going to be exactly what you need in order to file your tax return for the year 2014 and to get ready for the year 2015. Now, one of the things that I want to emphasize, and I'm going to for just a few minutes in the very beginning, is simply this, and I have it placed in red right there in the middle of the page. It's simply this: paying taxes is the law. Each and every year, I'm amazed. There's people that come along and say, you don't have to pay any taxes. I haven't paid taxes, somebody may say, for 10 years, so that proves that you don't have to. But guys, nothing could be further from the truth. Taxes are part of the law. They're legal, and if you willfully decide not to file, the IRS will hunt you down, and once they hunt you down, they add substantial penalties and interest for not filing. So always remember, file your return. People have asked me, because there always comes along people every year holding seminars that state they know that you don't have to. However, the 16th Amendment to the Constitution of the United States of America simply states that Congress has power to levy a tax on all citizens. So again, I'm just reinforcing the fact that it is part of our entire country and part of our national Constitution. However, on this slide right here at the very bottom, and this is what I want to talk about now for just a minute, there was, at the beginning of the 20th century, so that's well over 100 years ago, there was a very famous Supreme Court justice whose name was Learned Hand. And Supreme Court Justice Learned Hand, as he was writing an opinion, he simply put, and I put this in quotation marks, but close to as possible, there's nothing wrong in paying the least amount of taxes possible. Nobody has a duty to pay any more taxes than the law requires. And I think that that's something that's very, very important. I know people who simply say, I'm not going to worry about my deductions, it's just way too hard, way too complicated. And I sit there and say, don't do that. We have a tax code that is built to help you and to be able to deduct expenses so that it can lower your overall tax bill. what we want to do is what's called tax avoidance. Tax avoidance is the art of taking the existing laws as they're written, using them, and then using them, paying the least amount of tax possible each and every year. Tax avoidance is legal and it should be practiced by every person. However, another word that's very, very close, but that is something that you can't do, is called tax evasion. Tax evasion is when you pay less than the full amount of taxes that you rightfully owe to the government. For example, if you decided not to include different things, but maybe it's a W-2 on your tax return, or maybe it's your Youngevity income on your tax return. If you start getting into the business of not including items on your tax return that are supposed to be there, or if you start inventing expenses that are not true expenses, that's called tax evasion. Tax evasion is a felony, and if the IRS catches you with that, you usually they do prosecute for that. Before you file, and actually it's something that people ought to think about as part of their Youngevity business, there's really two basic forms, or two basic establishments or ways that you can file your tax return, or you can treat yourself. The first way is what we call the sole proprietorship. And on a sole proprietorship, that's generally one person. Let's say that I sign up today, I earn a couple $1,000s, I decide that I'm going to be in business by myself, and I don't want the protection of a corporation. I don't want the hassle of being a corporation or what's called a limited liability company, so I am going to be a sole proprietorship. This is how the vast majority of all the people in network marketing file their tax return. Most important, there's two forms that are most important when you're filing as a sole proprietor. First is what's called a Schedule C, and we'll show you in Part 2 how to put numbers of what you've earned as well as what you have to deduct on a Schedule C. But Schedule C is where you'll place the income that you've earned, and also a form Schedule SE that we'll talk about in just a minute. But Schedule SE is for self-employment tax. One thing you need to know, though, about being a sole proprietor is that if you ever get sued for anything that you do in your business, everything that you have is at risk. For example, I knew someone who was having a party at their yard. Someone stepped in a hole. They, I don't know if it was they broke or they tore ligaments or exactly what it was that person did. However, that person filed suit against the other person, and that other person had to pay quite a bit of money. That will always happen when you are a sole proprietorship. However, there is another form of filing that more people are starting to use, and I would dare say if you are earning more than about $500, and by earning I mean net earning over $500 a month, I would seriously consider forming what's called an LLC, or a limited liability company. And a limited liability company is exactly that. Take the first two words, limited liability. So in a sole proprietorship, you have liability for any and everything that you do. As a person who has a limited liability company, you are only responsible for the assets that are part of that limited liability company. Each state has different rules, laws, and regulations as it pertains to a limited liability company. When you go to form the LLC, as it's often known, the acronym for it, a lot of people will have an attorney help them, or they will Google, go online, and learn how to form an LLC. But you need to know that each state is just a little bit different in what is allowed for you to be able to do. So for me to be able to go in and tell you what you can and can't do in a specific state would be almost impossible for me, because I am no longer a practicing CPA, and I don't go in and learn the rules of all 50 states. However, again, if you are earning at least $500, I would say, a month, and you would like the protection or limited liability protection, an LLC is a wonderful form of business that you can be. Now, anytime that you form an LLC, there's two people, and a lot of times when people join and they form an LLC, the two people are a husband and wife, or maybe it's a person along with their parent or someone like that. There needs to be at least two people, and the technical term, because if you receive anything in the mail or anybody starts talking to you, each person, each one of those two people are called members. Members of the limited liability company. And as I just said, one of the other great strengths about the limited liability company, as I said a second ago, you have at least two members. But the greatest thing to me is the fact that it's taxed as a partnership. And the reason I say that's one of the greatest things is it simply will give you the ability to deduct more things than if you were a corporation and trying to use that for limited liability. You've got the great ability in this situation to file as a partnership. And since you'll be filing as a partnership, the form that you need to use is called Form 1065. In Form 1065, again, in Part 2, we will show you where to put the income that you've earned, and also where to place the expenses that you have incurred during that year. A minute ago, I also talked about Form SE. The Direct Selling Association estimates that 99.9% of all people involved in network marketing will end up filing Form SE. And the SE stands for self-employment. Whether you are a sole proprietor or whether you are a member of an LLC, you will end up filing a self-employment tax form. And that is basically the same as if you were working for an employer. If you were working for someone else, they would withhold 6.2% for Social Security, and they would withhold 1.45% for Medicare from your check. Then the employer has to match that. But since you're in business for yourself, the self-employment tax is approximately 15.3% on your bottom line. So everybody needs to make sure that not only do they file their tax returns each year with this form, but also, and what's very, very important, is that you are saving up during the year and filing estimated tax payments once a quarter from your self-employment tax form. Again, we will show that in Part 2. Now, people often ask, what can I deduct? And I took a couple of these statements directly from the IRS code. Now, if you want help in understanding different items that you can or cannot deduct, one thing that I would invite you to do is to simply Google, and I use the phrase network marketers IRS 2014, and that brought up the vast majority of all laws. However, what is very, very important is it tells you that you can deduct the business expenses. Then that asks the question, well, what's a business expense? And the answer that the IRS says is any and everything that is ordinary and necessary. So any expenses that are ordinary and necessary. Now, for example, I've always wanted a new boat, and just because I buy a boat and take somebody, a client out once a year, that does not make that brand new boat that I'd love to have ordinary nor necessary in our course of business. So the deductibility would not be allowed. And ordinary expense is one that's common. It's what people use in our everyday type business, the normal expenses. Now, for example, maybe you're going to go to a CEO school. If you go to a CEO school, you can deduct. If you take an airplane, you can deduct the fee that you paid for that. You can deduct the hotel fee. You can deduct the meals while you're away from home. Those are ordinary as well as necessary to help you in your business. In reality, the IRS wants you to be able to earn money. And so they set this up so that you can deduct what's ordinary and necessary, but only to that extent. Part of the ordinary and necessary comes down to the record keeping. One of the biggest areas that people get in trouble every year if they get into a tax audit is when the IRS tax agent asks you for a copy of your receipts. For example, if you deduct $10,000 for airplane fees, or cost, I should say, the IRS agent will simply ask and say, Keith, you deducted $10,000 for airplane. Can you please show me those expenses, because that seems to be quite high. As long as I saved a copy of either my the ticket that I have that shows the amount, as long as I have something that shows that what I spent for that ticket, that I have abided by and made sure that I've kept the necessary information so that an agent can clearly see that that is an ordinary and necessary expense. The IRS also states that you need to be able to prove to them the amount of money that you earn and the amount of money that you want to deduct. So that record keeping becomes very, very important. And for example, every month I have my Youngevity check that comes to me. And as part of that check, it gives the breakdown of how much it's earned. And so what I do is I simply take the check part off the bottom and I keep the other part as proof of how much money that I've earned during the year in case I'm ever in a tax audit or in case I'm ever in a situation where I need to prove how much money was made during that year. The thing that's very, very important is down towards the very bottom where it says that the evidence needs to be very, very clear of the amount that you paid, the date that it was incurred on, the place, and why, what about it makes that expense ordinary and necessary. So if I've taken someone out to eat, I will write on the receipt took John Doe to eat on such and such date. We discussed him joining Youngevity. Here I have, we're going to start showing you a simple method for you to be able to keep track of all the money that you have earned, as well as all the different expenses that you've incurred. Now, this can be done on something as simple as a spreadsheet, such as Excel, or it can be done using a tax program, or not necessarily just a tax program, but a method to be able to show how much you've earned during the year. The software that I choose to use, it's not that expensive. I think it's about $200, but it's called QuickBooks. And QuickBooks helps me so that every day, if I want to know how much money I've made during the year, I would be able to go in and tell. But if you're in this situation, what we're doing is we're showing an Excel spreadsheet so that it's something that the IRS agent can see, again, how much you've earned. In this situation, we don't have enough to show all the checks that you could have earned for a year. But as you see, I have a column for the date. I have a column for the weekly amount of checks that I would receive, a column for the monthly amount, and then a column for the total. And that total, of course, is what will then be entered on your tax return. Next, for expenses, I do the exact same thing. I simply come in, I make different columns, and if you'll notice, I also make different headers right across the top, so that as I'm putting down the different expenses, I'm placing that expense into a category. Now, at the very beginning, as you can see on January 14th, what I did, I have one column for the date, January 14th, the next column, to who did I or spend that money with, or give the money to, and I put down Delta Airlines. Sometimes, and I put a note, and the reason I put note is in case I need to remember, if it was dinner with someone, if it was anything like that, I'll put down someone's name so that I could remember, like in the example that we have here, under notes, I put down Michelle, so I can see that in this situation, it would be that my wife and I had dinner with Michelle, and that it cost us $48. Now, you will see that I've made different columns, and in reality, you will end up making more columns than I've made in this example, but under these columns is where you categorize each expense. For example, under Delta, I put that expense categorized under airline. Under the Sheraton, I have a category called hotel. If the amount was $119, I would put that amount under hotel. And then I go down all the way through the year, putting every one of the expenses, and by that I will know at the end of the year the expenses that I will be able to use. One thing that is very, very important is under food, make sure that after you total up what you have for the year, that you divide it, or that you only can take 50%. So in this situation, if I spent $62 for food, I'm only going to be able to deduct $31. Remember, the food, you can only deduct 50%. But if you use something simple like this, or QuickBooks, it will help you. One expense that is very, or at least in my mind, it's a great expense to be able to deduct each year, is the automobile expense. I have taken and placed the type of automobile log that I keep in my car at any time. I have a column for the date, where I'm going, the business purpose behind it, And then I also have my beginning and my ending odometer readings, so I'll know how many miles I actually drove on a particular day. At the end of the year, I add up all of those miles, and for the year 2014, you multiply all of the miles, all of your business miles, I should say, times 0.56. The IRS allows you to deduct 56 cents on every mile that you drive. And so that can really add up to a very, very good deduction, but you must keep an auto log. In fact, they ask you a question on the tax return: did you keep an automobile log or some form? And they ask you, is it written? And if you can't answer yes to both of those, then they will not allow you to take the automobile deduction. It's a great deduction. Please make sure that you take advantage of it. One more slide, please. The final one that I want to show you is what's called the participation test. Many times people join a network marketing company, and one of the reasons, of course, is because of the tax benefits. You can write off certain things that maybe in other situations you would not be able to write off. One example is the office in the home. You're able to write that off if it's exclusively used as an office for your business. However, what if you're in a situation where, for example, let's say your checks for the year that you earned were $5,000 and your expenses were $7,500. You would have a net loss of $2,500. However, you could only deduct those $2,500 from your taxes if you actively participated in your business in that year. There's 7 different tests. The easiest is what's called the 500-hour test. Every day that you start to work on your Youngevity business, keep a track of not only the date, but when you began, when you ended, so that at the end of the year, you can show that you kept a log and that you actively participated in your business so that you can qualify in case you did have a loss. Now, we're hoping that we don't have to talk about any losses. All we want to talk about is how people are making lots of money. This has been part 1 of a 2-part series. My name is Keith Halls, and I'm very, very grateful to each and every one of you who have joined us on this call. Please know, as I always love to say, we are involved in the greatest industry in the world today. And with Youngevity, we are involved in the greatest company in the greatest industry in the world today. I believe that with all of my heart, and I want to make sure that each and every one of you know that. And with that, this is the conclusion of part 1. Look, we will be posting when part 2 will be a live webinar. Thank you very much.